Welcome everybody to our personal finance series that we're doing. Today we're talking about credit cards, and I am joined by my man, Jeff Myers. Jeff, introduce yourself.
Hey, John. My name is Jeff Myers, portfolio manager for a local investment advisory shop in St. Louis, Missouri. I currently have my CFP, Certified Financial Planner designation, my FMVA, so Financial Modeling and Valuation Analyst designation, licensed by the government, so Series 7 and 66 to give investment advice, and then currently sitting for my Level 2 CFA exam, so Chartered Financial Analyst.
Okay, that's quite the list. It's good.
I got a lot of things I like to learn.
Nice. All right, so today we're talking about credit cards, which everyone seems to have or can have because they'll just mail them to you
Yeah.
for like no reason. You'll just a credit card will appear as junk mail. So uh, let's go into it because I think credit cards, they might be the most nefarious financial pitfall, scam, trick, tool out there, right? They're everywhere. There's commercials for it. Everyone's got one. Uh, yeah. So let's like what is a credit card? How do you think of a credit card, Jeff?
I think the best way to think about a credit card is um, basically a bank account that you don't own where you can pull funds out of, but you have to replace them over time plus interest.
Okay.
So, I mean, it's interesting because just about everyone can get a credit card as long as you can show proof of income. I mean, I'm pretty sure I got, like you said, I got five letters this week alone with different credit card offers in them. These companies just want you to take their credit cards.
Right. So let's for people who maybe don't know or maybe like younger folks, let's just go do what's the difference between a credit card and a debit card? Because I think I had a debit card when I was 16 that my dad gave me for like my little account, but that
Yeah.
is different from a credit card, even though
Yeah,
they do
absolutely.
they do look the same in your wallet oftentimes.
Yep. Yep. Yeah, they're essentially the same if you look at them in physical format, right?
Mm.
So when you open a bank account, the easiest way to access that bank account is through a debit card. And the way to think about that is you are debiting your bank account every time you swipe that card. So the funds that are available are instantly pulled out and sent to the merchant, whether it's the grocery store, the ATM, wherever you're going. As long as you have money in your bank account, that debit card pulls from it and the vendor gets paid essentially immediately. With a credit card, it's not necessarily a bank account, but what's called a credit line. So you have access to $1,000 on this credit card. Every time you swipe, same thing, the vendor gets paid the same way. But instead of pulling down your bank balance, what it's doing is increasing the line of credit that you've drawn. That eventually has to be paid back. With the debit card, you're taking your own money, paying it out. You don't have to pay yourself back with that. You're just reducing your bank account balance. With the credit card, you eventually have to pay that money that you've spent back plus interest.
Okay. Now there is like a credit limit though, right?
Correct.
Okay. And like that, I feel like when I was like in college, I got my first credit card. My credit limit was like $1,500 or something. Generally, it's low, right, when you first start out,
Right.
and
Yeah.
they'll tout that as like a safety feature for credit cards.
Yeah. Yeah. So there's some complicated formula that banks will do to kind of determine what is a safe line of credit based on other debts that you might have, other credit cards that you have. So credit cards are considered a revolving line of credit
Okay.
as opposed to a fixed line of credit, which maybe would be like for a fixed loan, for a car loan or mortgage loan. So the difference there is, the banks are going to look for that, what you have available in terms of the income, any other assets that you might have, what they can get their hands on if you don't pay it off, and then try
Okay.
to keep that to a small enough number to where you have the ability over time to pay it off. I actually think that my first credit card was $300 limit.
Wow, I didn't know they went that low.
Hey,
You were not a trustworthy person when you were
not
over eight.
trustworthy? No.
No,
When I was
no,
18 or 19,
no.
definitely
They're
not.
like, well, we can get a bike out of him if he doesn't pay back. So what? So like, why are credit cards evil? I'm just gonna throw it out there. Okay, everyone knows credit cards are not everyone because there's tons of people with credit card debt. But
Yep.
the saying is like credit cards are bad. Are they?
Yeah, I think this goes back to kind of how we started in our last episode, right? It really depends on the mentality and the behavior of the person using the credit card. Now, the biggest thing I think that people are unaware of with credit cards is the interest rates.
Okay.
And
What are the interest rates on a credit card?
I think the minimum interest rate is something like 15 or 20%.
Okay.
It's usually prime plus a large double digit number.
Wait, what
Even
can you go into that? What does that mean? Prime.
so prime is the interest rate that the Federal Reserve charges banks.
Sure.
So it's really, really, really super low, right? So it's like maybe 1%. It might be 1.25. It's a really low interest rate. That's what banks. That's like the minimum that banks have to charge
Okay.
because that's what they're getting charged. Now
Okay.
they add on top of that an interest rate depending on the product, the loan that you're taking out, some amount for them to actually make money and cover their expenses.
Sure.
For credit cards, it's usually I have not seen a credit card lower than 16% in the last few years. Those
Okay.
interest rates are crazy. And on top of that, credit card interest rates compound daily.
Okay.
So most of your loans will look at the balance every month, sometimes annually, depending on the loan that you have, and calculate the interest payment based off of that balance. The credit card will look at the loan every single day, the balance every single day, and calculate interest off of that. So your daily interest will accrue, and then you get hit with an interest charge every month. So that's something that a lot of people are unaware of. So the longer you hold a balance on your credit card, the more you're going to get charged at that interest rate. And if it's something like 18%, it's really going to hurt you.
Right. What I always think about with like credit cards is there's that Einstein quote that the most powerful force in the universe is compound interest, and the companies are using that against you in this
Yep.
situation.
Yeah,
So
exactly. It's
so
definitely being used against you.
so it's definitely like credit cards aren't something to take lightly, even though they're treated lightly and for a reason. I don't
Yep.
think it's to view them as just whatevers or a thing you have, I think is naive probably.
Yeah, and it's unfortunate because I think you mentioned this earlier. Like there are commercials all over the place, ads all over the place for how great this credit card is, or how it pays you 1% on all your purchases, or
Right.
whatever that is. You get some form of cashback rewards. And
Right.
there's a time and a place for those, but for the majority of people, it is not helpful. And like we talked about earlier, it digs you into a hole that oftentimes most people are almost like unable to dig themselves out of because they have so much debt that they carry because of their credit card usage.
Right. And the other thing that's kind of, I think, a little evil about this is like if you, their commercials are oftentimes really funny and kids love them. So
Yep.
it's just, there's a little bit of like they're priming the pump for when people turn 18 so they can get them.
Yep. Well, and they made it even easier when they came out with college age credit cards, right? Because it used to be that you couldn't get a credit card until you had an income. Like you have to show pay stubs to be able to get
That's
a
true.
credit card. And now in college, most of us didn't have jobs. You can still get a credit card without a job. And
Oh, wow.
that's where it's really dangerous because what you're doing is that person, they're being set up to rely on someone else to pay off that debt,
Hmm.
right? So if you, let's say you have a job or you don't have a job, 18, go to college, and your parents, give you a little bit of spending money for emergencies, but you want to go out with your friends or you want to play around or buy dinners a lot or something, and you get a credit card, you use up that credit card, you don't have any way to pay it back. So you've got to go back to your parents or someone else to be able to get money out of that. Now, ideally, in a perfect world, that would set you up to get a job to then
Hmm.
pay it off, right? To be
Right.
smart with your finances. But that's not always the case because we're fallen beings, right? We're gonna take the easy road as often as we can.
Right. So it seems like the culture and the marketing schemes in these companies are trying to kind of develop bad financial habits in some degree.
Because
So
it's
I
to
mean,
their benefit.
right. And that's not some like conspiratorial plot. It's just something to be aware of is that
Right.
it's to their benefit for you to be financially irresponsible.
Right. Exactly. Because
And
as
that's
long as you carry a balance, they get paid that interest because
right,
they're going to pull it automatically. They'll automatically add it to your balance. So whether or not you pay it off at the end of the month or in 2 months, you're still going to get hit with that finance charge. Now, the goal is to pay it off at the end of this month because then
right,
that finance charge is lower than at
right,
the end of next month or the next month or the next month.
right. So let's talk about that specifically, like paying off credit cards, and let's talk about what I think is probably the biggest scam in all of finance: the minimum payment.
Yeah.
Right? Like that's can you kind of dig into like what is that? Why? Like when I log into Citi card and they say minimum payment in big block letters, why is that the biggest like thing they want me to do? Why do they want me to pay the minimum payment?
So as long as you pay the minimum payment, your balance will diminish very, 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 very slowly. And the slower your balance diminishes, the longer the company gets paid. So if they can tout a really nice, easy to handle minimum payment, they're going to get paid for a really long time.
So the company's incentive is then to like it's to string you along essentially,
Right.
pull you along,
Exactly.
right? And I think you have a tool you want to show us that
Yeah,
kind of
exactly.
displays this. All right, let me put it up on the screen.
Awesome. Yeah,
There we
so I've
go.
got a little payment calculator here where we're just kind of taking a really simple situation where we've got a credit card balance of $2,500. That's current balance. So we've already spent that $2,500. Very, very normal 18.99% interest rate for a credit card. We can choose, kind of any.
Do Citibank because
Let's
that's
do
my
City
bank.
because this is yours. Yeah, exactly. So let's say they're telling us that the minimum payment is $75 on this $2,500 balance.
Hmm.
What that means is it's going to take us 4 years to pay off this credit card. And on top of that $2,500, we're going to pay an additional $1,000 of interest. So that means that this company is going to receive a pretty hefty payoff on top of their balance. So they're going to make 43% off of the balance that you're holding because you're paying the minimum payment. So in terms of lining their pockets, that's exactly what you're doing. You're just paying them to hold on to basically your future earnings potential.
Right. That seems to be like the trick with all of this is you think, well, the interest payment is 19%, we'll say 20%, but it's not 20% of what the credit is. It's 20%, like not even per month, right? You said 20% chopped up per day of the month
Yep.
and then compounded. So really, they want to use time against you in this process of not letting you dig out of a hole.
Right, exactly. And that's why it's so powerful for us to think about budgeting and to be so focused on, finding a little bit extra money if we're in this type of situation where we might need to get out of credit card debt. Because if you can go from $75 a month to $150 a month, look at the time change that happens here. We've just reduced this by 28 months
Right.
and dropped the interest dollar amount that we end up paying over time by $600. So that's a huge increase in time to get out of debt and a huge decrease in the amount of interest that we end up paying this company. So if you can think about these things and really like take the time to realize that what they're trying to do is string you along for a long period of time, you take the time to add a little bit of extra money to that payment to get it down, you'll be in such a much better position in the long run because of that.
So yeah, it seems like with this that biting the bullet and paying stuff off now pays dividends. Like it does help.
Yep.
It there's just a huge like a return on that. Like if you can
Yeah.
find an extra $75 a month, you cut it down in more than half. So you double your payment, but your payment's cut down by more than half. And sorry, it takes 20, you say 28 less fewer months
Yep.
and almost $700 you save.
Yeah, we went from 4 years to pay off this $2,500 credit card to less than 2 years now
Right. Almost a
because
year and a
we
half. Yeah.
found I mean, it's tough though because often doubling your minimum payment is a challenge for people, right? But that's where you have to be aware of these things when you get into this type of situation because if the minimum payment is all that you can make, then you really should not be getting a credit card at all
Right.
because what you're doing is you're taking that, you're really focusing on that instant gratification instead of delaying it to be smart and to plan and to budget. And that's why oftentimes you get into a situation where, especially around the holidays, right, we get an exorbitant amount of credit card offers and credit card ads, because what companies want you to do is to spend that extra money on
Mm-hmm.
presents for people. And of course, like, mentally, we emotionally, we want to give gifts to people. We want to be able to take care of our families and provide for them in a beneficial way. But if you think about the long-term detrimental effects that this has on you, your family, your finances, your ability to save, it's massive and it's terrifying. And I mean, I agree with you. I think that's why it can be so evil.
Right. So let's talk about like like if you are in a situation like you're like say you're in this situation, what are like strategies to get out of it? Like you're in an amount of debt that is hard for you to pay off, right? We don't need to say a
Yeah.
specific number. It kind of
Right.
varies on everybody's position. What is like what's the strategy? I mean, obviously paying minimum is the minimum you could do.
Yeah.
Is it like is it pay I guess pay more, scrounge for every nickel you have? Like what would you say?
So there's a couple different approaches to this. If you, let's say you have a few different credit cards that need to be paid off,
Hmm.
there are multiple ways to approach this. I think there's one that's called the debt snowball, um, and I think that's the one where you focus on the smallest balanced position first. So let's say we have three credit cards. One has 1,000, one has 2,000, one has 5,000. If
Right.
we focus all of our extra money onto that $1,000 credit card, pay that off, then we take those funds and add it to the 2,000, and then we
Mhm.
take all of those funds and add it to the 5,000. We can snowball everything, pay it off.
Right.
The other approach is to look at the interest rates, figure out
Sure.
which one is the highest interest rate and pay that one down first. But I think the key to all of this is really taking the time to step back and look at your budget, look at your spending, see why you're in this situation. If really all you can make is the minimum payment, then there might be something in your budget where you're spending where maybe you don't need to be spending.
Right.
And kind of like we showed just a second ago with that chart, if you have Netflix and Amazon Prime and HBO and can barely make a $75 a month credit card payment, maybe cancel those for a few months, and that gives you an extra 30 or $40 to pay onto your credit cards. That can help you get out of debt faster.
That's a really
And
good
so
point.
I think that's really important, and we often forget that, you know, oh, I've got all these little tiny subscription payments that I'm making. They're not really that big of a deal. But if you
Right.
look at all of them together and take them off and look at the impact that it has on your debt, and you can use that money to pay off your debt, it makes a huge difference in helping you get into a better financial position in the long run. So I think really the best way to start with that situation is evaluate your budget, evaluate your spending. If you don't have a budget, build a budget.
Uh-huh.
You can make that as simple or as complex as you want it to be. Um, there are tools available. There are apps that can help you do that. There are also, with the growth of interest, with the growth of credit cards lately, there's a growth of debt pay down apps as well. I'm a huge fan of financial technology, fintech, and looking at all these different apps on my phone. I download a lot of them just to play around with them and to be able to speak about them to people.
Hmm.
There are a handful of them out there that will, if you have credit card debt, help you tackle it. So Credit Karma is a really good one for tracking your credit score, but they also help you evaluate your debt, and they have a credit score simulator, a credit pay down simulator. You can test, hey, if I can drop an extra $20 onto this payment, how will that help me get out of debt? Mint does the same thing. So there's a lot of applications out there now that will help you plan for the future to get out of debt if you're seriously struggling in that situation.
That's good to know. I didn't realize that there were that many apps for it. And
It's
then so you
cool.
okay. Sure. Yeah, yeah, yeah. Uh,
I love numbers. I will sit and play with those apps all day long.
okay. And then I do like we did talk about like regular payments, but uh it helps to even drop in a lump sum, right? Like if whatever you come across
Yeah.
Even if you owe like $3,000, but someone gives you, or you maybe get a stimulus check for $400, throwing that in there and just taking out a big chunk of it, that helps in the long run too, right?
Yeah, so pull up the chart again really quick and let me the table here, and let me show you what that effect has. So if you see the
Sure.
way that these payments are broken out, each payment, a portion of it goes to principal and a portion of it goes to interest payments.
And
If
we
we
should clarify, principal is what you owe. So it would be that
correct,
2,500.
yeah,
Okay.
exactly. So that's what actually comes down. So if you look at your 2,500 minus 110, so what you're paying a port. So instead of this 150 going directly onto that to $2,500, it is dropped down to 110 because that other roughly 40 is paying off that interest charge.
Hmm.
So then you're left with roughly 2390. So, but if you look at this, so each payment is separated out into principal and interest. If we increase this payment amount, what it doesn't change the interest charge, it changes the principal that you're paying down. So we're paying 110 in principal on a $150 payment. If we increase that to 250, our
Oh, look at
principal
that.
paid goes up to 210.
Right.
So let's say you get into a situation where maybe you get $1,400 stimulus check and you drop all of that onto your credit card. Oh, it's got to be lower than that.
There you go.
So that principal amount right there is almost, it's just about $1,000. So that's going to take you down almost half of the way to paying off your debt here. So that's going to be a huge, and look at that, your interest pays $73. You paid off in 3 months. Now, of
Right.
course, we can't always do that every month.
No, but
It's not possible to always find $1,000 extra a month.
no, but if you do find an extra 200 somewhere, that's certainly a thing that can happen over the course of 2 years while you're paying off a credit card.
Yep. Yeah, exactly. And it's a tough, it's unfortunate because when you dig yourself into that hole, it's a challenge to get out of it, and
Right.
often it takes a long time and it takes a lot of discipline to be focused on that goal because it's not going to happen right away. Not we don't all get windfalls that we can use to kind of pay everything off at once. We have to kind of
Right.
work our way, chunk it off over time as we
Hmm.
get to paying off that debt.
Great. Great. So that's kind of like the bad part of credit cards, or like this is you found yourself in a bad credit card situation. What's the optimal way to use credit cards?
Yeah, so I can think of two really beneficial reasons for using a credit card. The biggest one is actually there is a good amount of fraud protection associated with a credit card. So we've seen that, we saw this a couple years ago with Home Depot and Target. If you remember this, there was some fraud scandals where people swiped their credit cards or their debit cards at the machine at the store, and that information was stolen by hackers who were then able to access bank accounts. So part of the detriment of using a debit card is that you swipe that, it goes directly to your bank account. So
Uh,
theoretically, a hacker could be able to get a direct feed to your bank account and pull money out of there. If you have a credit card, there's fraud protection associated with that, where if someone spends on your credit card and it's not you, you can call the company and say, hey, I didn't authorize this $500 payment. Hey, I didn't go out here and buy this. They'll cancel that charge, and you are only liable for up to $25, maybe $50. I don't remember the rules specifically, but it's really low. And so you have a really small charge on someone who maybe just took you for a run on your credit card. And so in terms of protection there, it's really beneficial, and if used wisely can be helpful.
that's great.
Yeah.
What is used wisely? Is it just paying off your credit every month and just being on top of it? Is that the trick? Is there any way you would want to let the interest accrue or get paid to you, or
It depends. You could be in a situation where you might want to be building credit for a specific event, like maybe getting a home loan, a
yeah?
mortgage.
Well, let's talk about that more specifically. What do you mean
Yep.
by building credit? Like, what does that
Hmm.
mean?
So when you apply for a loan, or when you, so a lot of times employment nowadays will also check your credit score. You basically get assigned a credit score based on your payment history, the length of time you've had any sort of debt available to you and the type of debt that you have, whether that's mortgages, revolving credits, so credit cards, auto loans, personal loans, that type of thing. All of those goes onto your permanent record, if you want to call it that.
Okay.
And you have the ability, by keeping your credit limit on your credit cards below 30%, that can show that you are capable of paying them off and capable of carrying a balance without it being a negative effect on you. Now that's a smaller portion of your credit score.
Okay.
What's actually a larger portion is the length of time that you have these loan payments open. So if you have a credit card that you opened when you were a college student and it's been 25 years, that 25 years is beneficial to your credit score. Now
Okay.
we can make the argument, how important is your credit score? We can probably, that's probably coming up in another episode.
Yeah.
But that's something where getting a credit card and paying it off on time payments, keeping that balance low, can help you to build up a credit score. I would argue that it's not necessary though.
Oh, but we'll save that whole credit score discussion for another talk.
Yeah.
It's a big one. I would say kind of goes against the prevailing wisdom out there. So I'm curious for that talk. Okay.
Yeah, I think that'll be a good one.
Yeah.
But so the way to use them wisely, I think, is absolutely paying them off monthly. You really don't want to be carrying a balance unless you're the type of person maybe that has an exorbitant amount of wealth. You're using your credit cards to pay for things and you pay them off, as you see fit. You're not really concerned about your credit score, that type of thing. It's a
Yeah.
really small percentage.
So unless you're some sort of oil tycoon or billionaire who just
Yeah.
doesn't care.
Bitcoin miner, maybe.
Sure. Okay, great. So unless you're one of those people, then pay it off. Great exception you threw in there, by the way. Well, unless you're living a luxurious life where you don't care about money. All right, great. We covered a lot. Is there anything else about credit cards you think we needed to talk about in terms of just anything?
Yes. Yeah.
Oh, what is it?
I can't believe we forgot this, right? What's the biggest thing that we see on TV about credit cards? Points,
Points.
cashback,
Yeah.
travel points, all that stuff. That
Right.
is such a small benefit to having a credit card that, in my opinion, the cost outweighs the benefit immensely. But it reels people in, and you
Sure.
can get, you've got credit cards that they pay you 2% back on all your
Yeah.
purchases.
That's mine. That's the
Your
Citi
Citi
card.
card. Yeah.
Yeah. 1% on a purchase, 1% when I pay it back.
Yeah. Oh, okay. So that's a really interesting point, right? Most people don't understand that they get the cash back after they pay it down.
Oh, okay.
Right? So
Yeah.
especially when I was really young and I saw those credit cards, I was like, oh my gosh, every time I buy something, I'm automatically going to get 1 or 2 or 3% money. Heck yeah,
Yeah.
I'm just going to go buy everything.
Yeah.
It didn't compute in my head that you have to pay the money back to
Yeah.
get the 1% back.
I view it
Right?
as like a 2% discount on all things I buy.
That's good. That's probably a good way to look at it.
Yeah. So
But
you're saying there's no, like, I do know there are like financial gurus out there who talk about like point switching and like trying to take advantage of it. That's probably a discussion for another day and seems
yeah.
highly risky to me.
Yeah, I agree with that.
If you can pull it off, great. Seems like a lot of time. Seems like a lot of
Yeah.
time and effort for that.
And a lot of spending too, right? You have to pay. You have to spend a lot.
You got to spend the money to get those points. Great. All right. Now have we covered everything with
Yeah, I
credit
think
cards?
so. Yeah.
You think so? All right. Good. All right. Well, I want to thank everybody for watching, and hopefully you found this informative and you learned something about credit cards. Please remember to like the video and subscribe to the channel if this was helpful, or if it wasn't helpful. I don't care. Like and subscribe. Thank you, Jeff, for joining me, and thank you, everybody, for watching.
Thanks, John.